Hi friends, so welcome to JK Shah Online. I am Professor Rahul Danait and I will be taking your paper 2 of CA final, that is Strategic Financial Management SFM. Yes, students, in this particular video I am being asked to give a small introduction of myself to you. In childhood, I remember we used to have this myself essay where 10 points, 15 points on myself we had to write. Similar introduction I'll give to you today. Students, by qualification, of course, I am a chartered accountant. I cleared my CA final in my first attempt at the age of 21. I was, of course, a student of this esteemed organization JK Shah classes, and today I'm very honored to be a part of the faculty team to teach all of you, the next generation chartered accountants. Students, as far as my career is concerned, it spans over a decade of teaching CA Final SFM and also CA Inter FM. As far as CA Inter Financial Management FM is concerned, I have also written a 600-page book on it. And as far as CA Final SFM is concerned, I have created this beautiful product for all of you all. What I have done in this product for all of you all, what all you will be getting, what all you can expect from this product, I will be sharing with you in the next video, which will be the introduction to this subject of SFM. Yes, so students, as far as I am concerned, that's it from my side. Thank you very much. Now let's start CA Final SFM straight away. In the next video, I begin the introduction of this particular subject, which is a very important subject from your exam point of view because it's high scoring. Yes, so thank you very much, students. See you in the next video. So let's start the introduction to SFM, Strategic Financial Management, for CA Final new course. Students, all of you coming from CA Inter, yes, must be wondering, sir, is this particular subject SFM similar to financial management we had in CA Inter in our previous year? Students, the answer that whether FM of CA Inter and SFM of CA Final, are they connected is concerned, I will say yes, slightly connected. Okay, there are some roots of SFM in CA Inter. So students, first of all, CA Inter. Children, as far as CA Inter is concerned, do you know what you studied in the FM there? It was the first time you encountered this subject of financial management, correct? Because before that, may it be CPT or may it be CA Foundation, you never had this subject of financial management. The first time you saw it was in CA Inter or CA IPCC. Students, in that financial management subject, what was being discussed? Only decision making. If you remember, decision making, corporate decision making, and I'll tell you to be more specific, there were 3 decisions that were discussed in that FM syllabus. I'll tell you which those 3 were. In the FM that you studied, the 3 decisions that were discussed were, one was called as financing decisions. Okay, what is it called as? Financing decision. One was called as investment decision, and the third one was called as dividend decisions. Now students, what are financing decisions? Financing decisions refer to from where to raise funds, how to structure my capital. I want 10 lakh rupees. Should I go for all equity or partial equity, partial debt? Should I introduce preference share capital? Should I take help of reserves? What should be the capital structure? I hope you remember. Yes, chapters like capital structure planning, cost of capital, capital structure theories, all that MM theory and all you had, you remember, all that form part of financing decision, where we studied from where to finance the requirement of capital for the company. I hope you remember this. Students, of course, once financing is done, the next decision that we went for was investing. Investing means how to invest the funds that we raised. Children, I'm very sure you remember the most important, the biggest chapter of CA Inter FM, capital budgeting, pertains to this investment decisions, because in capital budgeting, if you remember, we used to take a decision whether to go or not for a project. Yes, whether an investment should be accepted, should be rejected, etc. Investment decisions is what you studied in this particular chapter of capital budgeting. Under investment decisions, you studied in this chapter of capital budgeting, and of course CA Inter students had this capital budgeting and risk analysis also. I hope you people remember that. Yes, and of course the third decision is dividend decisions. Students, as far as dividends are concerned, more specific specifically equity dividends I'm speaking of. Equity dividends are concerned, how much dividend to give, how much to retain, whether the dividend decisions has any impact on the company's wealth or does it have an impact on the shareholders' wealth. All this discussion we had in this particular decision making of dividend decisions. You had a chapter called as dividend decisions in CA Inter FM. I hope you remember. So basically the entire financial management of CA Inter was divided, yes, in these three decision makings. Apart from this, there were two chapters of general overall analysis called as ratio analysis and leverages, and apart from that there was one working capital management. Yes, working capital management also I take it to be a part of investments only because it's a part of our assets, correct? We are investing in our working capital. Yes, so basically students, capital structure, cost of capital, capital structure theories, all that form part of financing. Capital budgeting, risk analysis and working capital management, which included management of cash, correct, debtors, receivables and overall working capital also forms part of our investment decisions. As far as dividend decisions are concerned, the chapter itself was named as dividend decisions, yes, and of course there were two broad overall analysis chapters that were ratio analysis and leverages. Yes, this was your syllabus of CA Inter FM. I hope you all agree. Yes. So now what is there for us in CA Final SFM? Okay. Students, at the outset I'll tell you, CA Final SFM is all about analyzing markets. Okay, it's all about analyzing markets. Now as soon as you hear markets, many of you are now jumping, saying stock market, Bombay Stock Exchange. Wait. Students, when I say markets, markets are not restricted to the stock exchange. That is the stock exchange, you know, that is the share market alone. Yes, that is one of the biggest and most important markets. But be patient, I'll tell you, there are, to be very specific, 4 markets we will be analyzing in this subject. 4 markets. One of them is called as the bond market. Okay, the bond market or the fixed income security market. Yes, the other market we will be studying is the equity market, which you all are jumping about right now. So bond market we will be evaluating, equity market we will be evaluating. Then there is something called as a derivatives market that we will be evaluating. Students, please, this is not the derivatives integration. Okay, this is a completely separate thing. Derivatives and integration is in maths. It's way in our historical past. No more of that now. This is a very interesting derivatives connected to the equity share market. So derivatives market is a very important, not only from practical point of view but also from your syllabus academics marks point of view, a very important chapter. So this particular derivatives market also we will be analyzing, and apart from that we will be analyzing a 4th market, that is the currency market, foreign exchange market. Everybody following? So bond market, equity market, derivatives market and currency market. These are the 4 markets which we will be delving into great depths to understand each of these markets and enter into the depths of each of these markets to understand it extremely correctly, both from the practical point of view as well as from the academic point of view. Everybody following? Students, apart from this classification of SFM based on markets, I have got another classification for you which is actually more relevant to you, because this classification of SFM that I will be giving now is more important from your academics point of view, okay, from your syllabus point of view. Everybody following? So students, I categorize SFM from your syllabus point of view into 2 broad parts, okay, 2 broad parts. One part is called as risk management. Okay, what is it called as? Risk management. And the other part, students, is called as valuation. Okay, one is called as risk management, other is called as valuation. Now students, I'll tell you what this is all about. Risk management and valuation, let's take them one by one. Okay, so students, first of all, risk management. Children, what is risk management? When we hear of the term risk management, I hope you people realize, to be very simplistic, there is some risk which we need to learn how to manage. Everybody following? So this particular term is very simple. We need to manage something. What we need to learn now is what is that risk that this particular subject is going to deal with and therefore manage. I hope you're understanding. Students, let me explain to you what this risk is all about. Children, here, this particular risk is defined as nothing but the uncertainty, I'll write down here, the uncertainty caused, by future, the uncertainty caused by future. Students, answer me. Is your past risky? Of course not. I'll tell you why. Your past is not risky because you know what your past is, correct? And because you know what your past is, there is no management that you need to do today for your past. It's already happened. It's completely irrelevant, correct? Your past is completely irrelevant. There is nothing to do today as far as repairing the past is concerned. It's all gone, correct? Students, as far as your future is concerned, is there any risk? Yes, there is a big risk as far as our future is concerned because we do not know today what will happen in future. I hope you're listening to me. We do not know today what will happen in future. And because we do not know today what will happen in future, today there is a stress, today there is an uncertainty, today there is a risk on my head because I do not know. There is no certainty of what is going to happen in future. This uncertainty that I do not know what's going to happen in future is called as risk in our SFM syllabus. I hope you people are understanding. Yes, this is called as risk in our SFM syllabus. Students, this risk, if it has to be managed, we will be learning how to do that in this particular syllabus. I hope you're listening. This risk, if it has to be managed, we will learn how to do that in this particular syllabus. Children, listen to me carefully. When I say that risk is uncertainty caused by future, and then I say that, you know what, I will teach you how to manage that risk. Basically, what am I talking about? I am talking about we are going to learn how to manage the uncertainty of future. Managing the uncertainty of future, can I say, is nothing but therefore creating certainty today. Are you listening? Creating certainty today is nothing but risk management. I hope you understood. So risk is the uncertainty caused by future. Managing risk means to create certainty, to remove that uncertainty, to remove that stress, to remove that risk, to manage that risk. And students, in this subject of SFM, this risk management, this removing of uncertainty, this removing of stress caused by future, stress caused because I do not know what future holds for me, and therefore to help us know today only what future will give us, to create certainty today only as far as future events are concerned. This risk management process, students, in our syllabus, in our subject, is very famously called as hedging. So whenever we will be using this term called as hedging is nothing but creating certainty. I hope you understood. Creating certainty today itself about future. Everybody following? So students, I hope you understood. Risk management is also termed as hedging. I'll give you a simple example, students. Very simple. Please pay attention. In your Inter-CA, you had this chapter called as capital budgeting. Yes, in your Inter-CA, you had this chapter called as capital budgeting. In capital budgeting, you used to evaluate projects. So what I will do is, I'll put a project in front of your screens here. This is a project. Now this project says that the initial investment required for this project is rupees 1 lakh. I hope you are able to remember your childhood. Childhood means IPCC or Inter-CA. Initial investment for this project required today is 1 lakh. Then the question says that this project is expected to give us cash inflows of, let's say, 20,000 for first year, 30,000 for second year, 45,000 for third year, and let's say 53,000 for the fourth year. That is the end of the fourth year. Students, these are the future cash inflows given to you expected from this project. If you take this project today by investing 1 lakh today, then they used to give you the cost of capital or required rate of return, let's say at 10%, and then they say calculate NPV. I hope you remember this. Students, how do I calculate NPV? NPV is nothing but present value of cash inflows minus present value of cash outflows. So students, for present value of cash inflows, if you remember, I will make here cash inflows, discounting factor at the rate 10% and present value columns. Students, in year what will I write? I'll write 1, 2, 3 and 4. Yes, so year 1, year 2, year 3 and year 4. I'll write down the data here. 20,000, 30,000, 45,000 and 53,000. Then I will take my calci. I will do 1 divided by 1.1 and then press equal to and get the discounting factors of 10% for each of the years. Students, 10% first year discounting factor is 0.909, second year is 0.826, third year is 0.751, fourth year is 0.683 and so on, correct? Don't look at me like this. I know all this. I've been teaching since a decade. Okay, now tell me, students, tell me. After this, what will happen is this into this when you do, can I say you'll get some PV of CI? I hope you understand. From this PV of CI, I will subtract the initial investment, that is the PV of CO. So what I will do is I'll write down here PV of CI minus PV of CO. When I do, can I say it is 1 lakh into 1 because it is happening today, right? So discounting factor is 1. So I'll write down here 1 lakh and of course PV of CI minus PV of CO will give us the NPV. Everybody following? PV of CI minus PV of CO will give us the NPV. Now students, let's say, it's not accurate, let's say. This is 1,30,000. Okay, let's say. Now don't take a calci and start solving and say, sir, you're wrong. Obviously, this is not the exact answer. I'm just taking a blind. I'm not even taking a guess. I'm just writing there 1,30,000. It's a dummy figure. Okay, so 1,30,000 minus 1 lakh. Your NPV at the rate 10% will come to 30,000 positive. As soon as students see a positive NPV, somehow they become happy because they feel as if this project is their own, and they say, I accept the project happily. You're right. Accept the project, no problem. What it means, when you say accept the project, what does that mean? It means, to be very, very, very practical, take 1 lakh rupees and put in this project, correct? Take 1 lakh rupees and put in this project, it is worth it. Why do you say worth it? Because this project, even at our minimum required rate of return discounting, is giving us a positive NPV, which means it is giving us a return more than what we want, that is more than 10%. Hence, we accept the project. Everybody follow until here. Now, my question to you is there any risk in investing this 1 lakh now in this project? Think and tell me. Is there any risk? Yes, a big risk. Sir, where is the risk? The risk lies here that as far as 1 lakh is concerned, there is complete certainty. It is happening today. It is happening at the beginning of year 1. It is happening at the end of year 0. We know today only 1 lakh has to be invested. So we invest 1 lakh today. There is no uncertainty as far as the outflow of the initial investment today is concerned, correct? But as far as the inflows are concerned, children, as far as the inflows are concerned, do you realize this 20,000, are you expecting to receive it today after 1 year, right? So today, can you be very certain that this project will exactly give me 20,000 after 1 year? No. What about this 30,000? Are you certain that after 2 years exactly you will get 30,000? Bigger no. What about this 45,000? Are you very certain today only that you will be getting 45,000 from this project at the end of 3rd year? Big no. As far as 53 is concerned, you all now know that it's a no, correct? We are not certain whether we will be receiving these amounts at the end of these years, correct? We trusted the question and we went ahead and we said, you know what, NPV positive, go for it. But students, I hope you understand there is a big risk in this NPV. The risk is as far as the future events are concerned. Today we sat and we estimated the future, but we failed to realize that the future might not walk as per what path you set, right? You thought this will happen, but the future might be completely opposite, correct? Students, the future can be better than this also. I am not saying that uncertainty is only negative. The uncertainty can be positive also. Tomorrow, the project might give you much more than what you thought, correct? The point is not that it will give you less or more than what you thought. The point is it will give you, or it might give you, different from what you thought. That is the uncertainty that we are talking of, and that is the risk we are talking of. So risk doesn't restrict itself that bad things will happen. Okay, risk is anything can happen. Anything means something different than what I expected for future will happen. That is called as risk. Which means if I today sit and think that at the end of year 2, 30,000 is expected to be received from this project, Yes, and that project in reality either gives only 10,000 or it gives 50,000. For me, both are risky situations, because students, I hope you understand that whether it is less than what we thought or it is more than what we thought, it is different from what I thought. And if it is different from what I thought, correct, it is risk. Students, risk obviously is not going to be experienced by you at the end of year 2, because the end of year 2 you are at present there, right? Risk will be experienced to you today at the end of year 0, when you estimate for year 2. Today when we sit and say at the end of year 2 we will be receiving 30, in this language, students, there is a risk. The risk is that the project might not give you exactly 30, it might give you 10 also, it might give you 50 also, it might give you 1 lakh also, it might give you 0 also. Anything can happen, and what is that anything? I don't know today. This is the risk. Everybody following? And in fact, all of you CA inter students should be knowing this, that because there was this risk in capital budgeting NPV procedures, that is why the institute had put a chapter in your syllabus called as capital budgeting and risk analysis, in which there were risk hedging tools, risk management tools like certainty equivalents, risk adjusted discounting rates, probability approach, scenario analysis. You remember all that decision tree, probability approach, and all such techniques you studied in the inter CA syllabus. So students, I am very sure by now you know that yes, future, yes, is uncertain, and therefore today we have a risk for the same. Everybody clear? Very simple. As far as your, let's say, 10th standard is concerned, when you were in 9th, you are fearing 10th, what will happen? I don't know, I don't know, I don't know. Now 10th has happened. Today you look back. Is 10th standard results risky for you? No, it's already happened, correct? It's already happened. Even if you failed in 10th, it is of no risk to you today, because you know you failed. There is certainty that you failed or passed, correct? Whatever. You know what happened in the past. But today if I ask you, are you certain about your CA final result? You will say, I don't know, sir. Yes, exactly. This I don't know means uncertainty because of future, right? Because of future. Future is unknown to us. That risk, students, is the risk that we are talking of in this particular subject of SFM. Students, in SFM, you know, we are decision makers, right? And since we are decision makers, today we take a decision by estimating the future, correct? And therefore our decisions obviously have an element of uncertainty because the future events are unknown. That risk, students, that uncertainty is what we will learn to manage, to hedge, basically to create certainty. So a big chunk of your SFM syllabus is dedicated to risk management, that is hedging. Everybody following till here? And obviously the second part, as I told you earlier, apart from risk management, this subject also deals with a concept called as valuation. Students, valuation, again a very, very, very interesting topic. I will tell you what valuation is right away. Students, valuation, very simple example I'll give you. Listen to me carefully. Let's say that you want to start a business, okay? You want to start a business. Students, if you want to start your business, tell me what is the most important thing necessary for your business? Obviously money, right? Capital needs to be invested to start your business. Now children, let's say that you need rupees 20 lakh, okay? You need 20 lakh to kickstart your business. Students, you do not have this 20 lakh right now. No problem. What to do? Inter-CA IPCC FM teaches us that broadly speaking, there are two sources of finance, right? Either I borrow the 20 lakhs or I ask someone to invest the 20 lakhs in this company and become an equity shareholder. Everybody following till here? Assuming we are starting a company, okay? The two sources of finance that you have are either go for debt or go for equity. Either borrow money and keep ownership, but then take the stress of paying interest, that is a financial risk on your head, or you do away with the financial risk, no need of paying anything fixed, invite someone to become, yes, in one sense a partner, a part owner, a shareholder of your company by buying shares and investing 20 lakhs. Yes, in this particular route, the risk is sharing of ownership. Yes, nothing else. As far as financial risk is concerned, there is not there because we do not need to pay anything fixed to him. But of course, as far as running the business is concerned, there are other issues, correct? I hope you all understand. So students, two routes now in front of you. One is the debt route, one is the equity route. Let us pick up the equity route. Let's say there is a person here who is willing to invest this 20 lakh in your business. Everybody following? This person here is willing to invest 20 lakh in your business. It is very easy now to take the 20 lakhs from him and give him the shares. Now I'll tell you what is difficult. This person will say, I will give 20 lakhs to your business. Yes, I will give 20 lakhs to your business and I want 100% ownership. I will give 20 lakhs to your business and I want how much, students? He's saying I want 100% ownership, completely owned. I will say nothing doing. You will give 20 lakhs, I will give you 50% ownership. Are you listening to me? So now there is a debate between the promoter of this company and this investor who is coming in. This investor says, I want to pump in 20 lakhs, but I want complete ownership of this particular company. I say, please give 20 lakhs, but not complete ownership. I can give you 50% ownership. Now this guy says, really? For my 20 lakh rupees, which is going to be invested in your company, you will give me only 50% of the company? I say, yes, not more than that. He will say, okay, done. No problem. We become happy. Wow, thank you so much. With the 20 lakhs, I can now give you 50% shareholding and 50% still stays with me. For example, okay. He says, don't start jumping. Wait, answer my one question first. I'll say, okay, ask. He says, I will give you 20 lakh rupees in the form of equity investment, no debt, no interest to be paid. I am an equity shareholder in the company, everything agreed. And I also agree that for my 20 lakhs, you are going to give me a 50% stake in your company. No problem, agreed. But for that, answer one question. Who said to whom? This investor is asking the promoter, that is us. He is asking, answer one question. How did you find out the value of your business to be rupees 40 lakhs? I'll again repeat the question this particular guy is asking us. He's saying that if you people say that for my 20 lakh investment in you, you will be offering me 50% of the stake, no problem. Prove to me that your company's valuation is rupees 40 lakhs. Makes sense, right? Because if he is investing 20 lakh in a company which is worth 40 lakhs, then he's also happy that yes, in a company worth 40 lakhs, if I'm investing only 20 lakhs, I am entitled to a 50% stake, correct? He says, prove to me that your company is worth 40 lakhs, its valuation is rupees 40 lakhs. Now children, if you are in this promoter's shoes, how do you propose to convince this investor that your business, your company's valuation is rupees 40 lakhs? Will you say, come on, understand it to be 40. Come on, give the money, let's start. Can you do that? No, he will not give money. He needs some concrete calculations, correct? He needs some concrete calculations whereby we can prove to him that our company's valuation is rupees 40 lakhs. Students, these calculations, I hope you're listening, these calculations are all embedded in this part of SFM called as valuation. I hope people understand. Yes, in this section of valuation, we will be valuing the values of companies as a whole, or sometimes equity shares, or sometimes only debentures, etc., etc. Students, very, very, very exciting concepts coming up in this particular valuation process. Everybody following? So students, I hope you understood. One is risk management, where we learn how to create certainty today about uncertain future events, that is called as hedging. And in valuation, we will be learning to calculate the intrinsic value, the theoretical value, or what the value should be. Yes, of a company as a whole, a business as a whole, or an equity share alone, or a debenture alone. There are various valuation models we'll be studying in this particular section of valuation. Children, all those of you who are coming from CA Inter, correct? That is a new course. You had this chapter called as dividend decisions. In dividend decisions, you have already been taught a glimpse of what valuation is. Yes, if you remember, there was this Gordon's model of valuing equity shares. There was a Walters model of valuing equity shares. I hope you people remember, even came in that chapter and valued equity shares. Students, valuation, a glimpse, you all CA Inter students have already tasted. But students, as far as I am concerned, I will be teaching valuation from the scratch. Don't worry. Yes, so risk management and valuation, two parts of SFM, will be delivered in this particular subject. So students, I hope you understood what this subject is all about on a very elementary base overview level. Yes, so students, in this video I will now stop here. I have given you a very brief introduction of what this subject is all about. In the next video, children, I will be explaining to you what I have done for you in this product and how you are supposed to use this product. It will be a user manual for you. The next video is a user manual for you, which you will have to compulsorily watch before you pick up consuming my product. Everybody following? I will be discussing some extremely crucial points regarding this course, that is Strategic Financial Management Paper 2 of CA Final, new syllabus, new course. Children, it is my sincere recommendation and request that you all watch the entire video, because after doing so, you will be getting a complete grip and a bird's eye view on what is to be expected in this course, what is to be expected in this product of SFM, and with that background you will be able to very correctly approach the subject. Students, I will be sharing with you few points as on how I have created this course so that you can then approach it correctly. Okay, so let us start. There are few points I'll be discussing now. Children, the first point that I want to discuss with you all is, see what you see on your screens now. Yes, this particular page is a screenshot of ICAI index. Okay, ICAI index of the new study material of paper 2 strategic financial management for CA final. Students, so I'll write down here, this is ICAI index. Okay, this is ICAI index. Now children, why am I showing you the ICAI index? Very important, please pay attention. Can you see the number of chapters here? Yes, there are these 14 chapters here. Students, I want you all to know that these 14 chapters are there in which chapters or which chapter numbers in our JKSC or this particular online course which I am sharing with you all here, correct? So this is a very important point you should know. So I'll write down here JKSC, and in that I'll write down my initials. Yes, this is the course that I'm presenting. Let me show you my index here so that you get clarity on how ICAI material is spread in my syllabus here. Okay, so students, the first chapter will start here. Chapter 1, Financial Policy and Corporate Strategy. Where is it included? In our product here. So students, I will show you my index now. So students, this is my index. So I will now straight away take you to, okay, chapter number 14, Financial Policy and Corporate Strategy. So students, do you realize that this chapter 1 of ICAI is chapter number 14 in this online course? Everybody following? Then children comes chapter 2, Risk Management. Now children, in risk management, let me make it very clear to you that there are actually two parts. One is the theory part and one is called as value at risk part. Value at risk, students, is a concept from which practical questions are asked and very frequently asked in the new syllabus papers. Okay, so students, what I have done is this VAR concept is there. Okay, this VAR I have taken as a separate chapter. Okay, I have taken as a separate chapter. You can see it here. Yes, chapter number 6 VAR. So I'll write down here that this VAR part is covered in chapter number 6, and the theory part, the other theory part of risk management, children, is covered in a chapter called as risk management here, chapter number 15. Everybody following? So I'll write down here, this is chapter number 15. Everybody clear? Of course, financial policy and corporate strategy is also a theory chapter, okay, which is there in chapter number 14 in the online product. Then children comes chapter number 3, that is security analysis. Okay, now children, security analysis, this chapter, okay, is covered here. Can you see this? Chapter number 16, security analysis. So I will write down here, this chapter 3 of ICAI is covered in chapter 16 of your online product, correct? Then students comes chapter number 4, that is security valuation. Children, as far as security valuation is concerned, there are two parts to this. One is the bond and debenture valuation, the fixed income security valuation and all about it, and the second, students, is about equity valuation. So what I have done is I have bifurcated both into two separate chapters. One, I will call it as security valuation 1, in which we will be including bonds, and the other will be security valuation 2, in which we will be including equity. Now children, as far as bonds is concerned, you can see in my online product here, that particular chapter is chapter number 2. Okay, that chapter is chapter number 2. So I'll write down here, this is chapter 2. As far as equity is concerned, that is security valuation 2, you can see here chapter 3. Everybody following? So chapter 3 I will write down here. So with that, students, we have discussed the first 4 chapters of ICAI, where all you will be finding it. Then children comes chapter number 5, that is portfolio management. Children, chapter 5 portfolio management in my product is chapter number 4. Can you see that? Portfolio management. So I will write down here chapter number 4. Everybody clear? Next, students, is chapter number 6, that is securitization. Students, securitization I have covered in my syllabus in the online product in chapter number 17. Okay, chapter number 17. So I'll write down here chapter number 17, right? Then children comes chapter 7, that is mutual funds. Now mutual funds is covered by me in chapter number 13. Everybody following? So I'll write down here chapter number 13. Then students comes this chapter 8, called derivative analysis and valuation. Students, derivatives analysis and valuation I have covered in this chapter number 9. Can you see this? Chapter number 9. So I'll write down here chapter number 9. Then students comes chapter 9 here of ICAI, foreign exchange exposure and risk management. Students, foreign exchange exposure and risk management I have covered in chapter number 1 of our online product. Can you see this? So I'll write down here, this is chapter number 1. Then students comes chapter number 10, that is international financial management. Students, international financial management I have covered in my online product in chapter number 12, correct? Chapter number 12 I have covered international financial management. Everybody clear? Then comes chapter number 11 of ICAI, that is interest rate risk management. As far as interest rate risk management is concerned in my online product, it is chapter number 11. So I'll write down here, this is chapter number 11. Then students, chapter 12, corporate valuation. As far as corporate valuation is concerned, students, I have covered it in chapter number 7 of our online product. I'll write down here, this is chapter number 7. Everybody following? Then comes mergers, acquisitions and corporate restructuring. Children, this I have covered in my chapter number 8. Okay, chapter number 8, I'll write down here chapter number 8. And the last one, children, startup finance. That particular chapter I have covered, yes, under chapter number 18. Okay, chapter number 18. So I'll write down here chapter number 18. Everybody following? Now students, if you see the index, 18, 17, 16, 15, 14, 13, 12, yes, and then 11. Now you might ask, sir, what about 10? What is there in 10? Children, currency futures and options. Okay, currency futures and options. Now where will we find this in ICAI is your question, right? Children, currency futures and options is a mix of, I will tell you, chapter number 8 and chapter number 9. Okay, chapter 8 and chapter 9 mixture is this particular chapter, chapter number 10, it was belonging to both of these chapters, so I've taken it out separately and kept it as a separate chapter. Okay, currency, futures and options. As you understand, currency refers to foreign exchange exposure and futures and options refers to derivatives. So this was a part which was there common between both, so I have picked it out separately and taken it as a separate chapter. Okay, and then students, there is this chapter called project beta. Children, this chapter you will find sometimes in mergers, acquisitions, sometimes in corporate valuation, sometimes in portfolio management. So what I did is I've just taken it out separately because it's a separate concept in itself, and I have taken it in this chapter, project beta. Okay, so it's a separate, very small chapter. So with that, students, I explained to you how the entire content of ICAI is spread in my entire online product. I hope you now have clarity as far as ICAI content is concerned, so no need to worry. If you are doing our online product of JKSC for SFM, you are covering everything. Yes, so that was my point number 1. Okay friends, so I have removed the markings and therefore let me come to my point number 2. Children, my point number 2 is regarding the structuring of the textbook. Okay, now students, let me tell you that as you know, there are how many chapters in my product here? There are 18 chapters in this course, right? So students, if there are 18 chapters, let me tell you something, that chapters 1 to 13 are those chapters from which practical sums are asked in the exam, and chapters 14 to 18 are those chapters which we call as the SFM theory chapters. Okay, so practical chapters and theory chapters. Now children, as far as the practical chapters are concerned, let me tell you that these practical chapters I have bifurcated into 2 segments. Okay, segment 1 are the practical problems and segment 2 is the theory which is given in ICAI new study material for those chapters. Are you listening? So there are 2 types of theories in SFM. One are those SFM theory chapters, and one theory is that theory which is there in those practical chapters also. Okay, so the practical chapters textbook content is divided into 2 parts for each chapter, for each of these 13 chapters. Yes, one will be the practical sums or the practical problems part, and the second will be the theory part. And as far as the theory chapters are concerned, children, there won't be any 2 segments there. There will be only one segment where we will be showing you the theory which is there in the ICAI new study material. Everybody following? So students, just for demonstration, I will show you this one chapter, that is foreign exchange exposure and risk management. It is a big chapter. So let me first of all show you the structuring which I am talking about. So students, if I go to this chapter, can you see here foreign exchange exposure and risk management? Correct? Foreign exchange exposure and risk management is a chapter 1. This particular table you see right now, you need not worry about it. I'll show you everything later. Yes, can you see this section A? Practical questions. Okay, section A, practical questions. Now if you scroll, okay, we will go to section B. Okay, so if we go to section B, yes, I told you it's a big chapter, don't worry, it will appear very easy eventually. Okay, so now coming to the end, yes, we can see here section B. Okay, now section B, children, can you see is theory. In theory, children, can you see I have given you theory questions also? Yes, theory questions are also there, which I would definitely recommend everyone to kindly go through, because students, from this also in the examination questions might be asked. Generally they are not asked, but might be asked. Generally SFM theory questions, students, are asked from those 5 theory chapters I've kept at the end, right? Chapters 14 till 18. But children, from this theory part of the practical chapters also, sometimes the theory question might be asked. So I request you all to also thoroughly go through this part. Everybody following? Yes, so this was as far as the structuring of this particular practical chapters is concerned. So I will take you back to the start now. Students, I hope you all understood what I'm talking of. 2 parts in the practical chapters. One is the practical questions part, and the second is of course the theory part. Everybody following? So now students, with that we complete our point number 2 discussion, that was about the the structuring of the chapters. Now let me go to point number 3, before which I'll just remove these markings. Yes students, so I have removed the markings and therefore let me come to point number 3. Children, my point number 3 is to explain to you something called as the module system which I have followed. Okay, now what is the module system? Module means a group of videos which are pertaining to a single concept. I'll again repeat, module is nothing but a group of videos which are pertaining to a single concept. Now how it helps us, I will show it to you through this chapter again, that is chapter number 1, foreign exchange exposure and risk management. Now children, can you see, this is your textbook, right, your first chapter. Can you see here module and video details? Now I'll explain to you what that means. Students, now tell me, in this chapter, look at the first column, module. How many modules can you see, students? You can here see a total of 24 modules. Okay, 24 modules. Students, therefore you should understand that this chapter I have bifurcated into 24 parts, and mostly speaking there must be 24 concepts. Everybody following? So let me explain to you how that works. Now let us pick up any concept. Okay, let us pick up, let's say, module number 5. What do you see here? Cross currency rates, which means in this chapter of Forex I have decided to keep a module called as cross currency rates. That means there is a concept called as cross currency rates, and pertaining to that concept there are these videos from 15 to 26, correct? This is the video number, this is the module name, this is the video name. So can you see that module number 5, cross currency rates, has videos ranging from video 15 to 26, and in that, children, you can find the video names also. Children, this is exactly how you will be getting the video structure on the website. Everybody following? When you will be enrolling for this product, this is exactly how the videos will be appearing to you. Everybody clear? So now children, can I say that you are getting a grip on what a module is? So students, next I can show it to you here. Can you see forward contracts? Forward contracts is my concept number 6 or module number 6 or part 6 of this chapter, and pertaining to forward contracts all these videos are there. Can you see one trend in this structure that I am creating, that the start video, children, will be the theory explanation. Okay, the start video will be the theory explanation and then all sums pertaining to it. So children, can you see that if tomorrow you have a doubt, let's say only in swap points, so you can straight away go to module number 8 and watch these videos. Everybody following? And children, can I also say that if I do more micromanagement for you, for helping you in your career, can I say tomorrow if you have a doubt only in, let's say, question number 42, question 42 of Forex you are not understanding, then you need not search for it, searching through hours of content. Straight away, children, the videos have been broken up so beautifully so that you can straight away click on video number 54, question 42 will start. Everybody following? Question 42 will start. You will be able to understand that particular question itself. So this is the micromanagement which we have done here, with the help of which you will be very easily able to not only complete your first viewing, but also eventually if you have doubts or you want to revisit some concept or some sum, you know exactly which video to see, because that index itself I have given it to you not only on your viewing browser on the website but also in your textbook. Okay, at the start of each chapter I have kept this module and video details. Everybody following? So with that, students, I explained to you now what the moduling structure is. That is of course going to help you a lot in your preparation of paper 2 of SFM. Everybody following? So with that, children, we complete this point number 3 also. So now children, let me go on to point number 4. Before that, I will just remove these markings. Yes students, so I have removed the markings and let me therefore go to my point number 4. Children, my point number 4 is about the practical questions which are embedded in this syllabus. Students, as I told you that there are in all 18 chapters, in which, can I say, 13 are practical and 5 are theory. Let me tell you that in all, okay, in all I have included 570 plus practical problems for you in this course. I'll repeat again, I have included for you 570 plus questions for you as of now in this course. And now you might ask me, sir, from where did you get all these questions? Let me tell you that my major source of questions is ICAI, and to be very specific, I will tell you something. Please pay attention. This is something that you'll be very interested to know. As far as SFM is concerned, children, do you realize that the questions for you need not be restricted from a question bank which is only pertaining to new syllabus, because the old syllabus also had similar chapters only. So of course from the old syllabus also the questions are relevant for your new syllabus examination papers also. So understanding that, I'll tell you what I've done. So I will show you here. This is old course, okay, old course, and this is new course, okay, old course and new course. Children, as far as old course is concerned, there were these past papers, okay, there were these past papers. To be very specific, children, I will tell you, I started taking it from 2003 till date. I'll again repeat, from 2003 till date, all questions, okay, all questions have been taken by me when I was creating the study material. As far as new course is concerned, children, the new course started only from the first attempt was May 2018. So I'll write down here 2018 till date. So the past papers, children, from old course 2003 till date, new course 2018 till date. Apart from that, children, I will now take something called as revision test papers, RTPs. I'm very sure you're familiar with this. As far as RTP is concerned, old course, children, 2014 till date, and new course 2018 till date, all RTPs I took into consideration. Then, children, there is this study material, okay, study material. I have taken the old study material as well as the new study material. Then, children, there is practice manual, which is not there in the new study material or the new course. It is there only in the old course, so old PM. So children, can you see this huge segment of a question bank? You know what I did? I took all the questions from this entire question bank and put it in one basket. Then I bifurcated all those questions chapter wise, and then I bifurcated those questions within the chapter module wise, that is concept wise. Everybody following? Which means, students, if you go back to forex chapter here, this chapter I'm showing it to you just for demonstration. All chapters, all practical chapters, you will see like this only. Yes, so we take any module here, students. Okay, let's take this only, cross currency rates. Now children, in cross currency rates, can you see these questions I have put in this module? Children, let me tell you that in this entire question bank, anywhere if ICAI has asked cross currency rate, asked in the past papers or mentioned in RTPs or study materials, if questions connected to cross currency rates were there, I have taken due care to incorporate that question in the module of that particular concept. Everybody following? And that is not, of course, restricted to this concept. This particular effort has been taken for all modules of all practical chapters. Everybody following? So this is our question bank that you will be dealing with, and therefore you should be very, very certain, and you should rest assured that we are having complete coverage as far as your syllabus is concerned. Yes, so that was my point regarding the coverage of questions, my question bank, from where I am taking 570 plus questions I've taken, and majorly from ICAI module and material only. Everybody following? Module means all the materials, RTPs, past exam papers, practice manuals, and so on. Yes, so with that, children, we complete this point regarding the questions. So before I go to my next point, I'll just remove the markings. Yes, students, so I have removed the markings now, and let me now go to my next point. Children, my next point is about a surprise gift that I am giving all of you along with this package. Okay, this course which you are enrolling for, I am giving you a small gift. I'll tell you what that gift is. Children, the gift is such that I will not only be providing you the videos, the textbook, that is the question bank, but students, I also took efforts to create your notebook also. Okay, your notebook also is ready, and there is a separate book called as Explanations and Solution book, which I have bifurcated into 2 volumes. Okay, Explanation and Solution book is a book in which your entire notebook is also ready. So students, do you realize that when you will be watching the videos, you need not get distracted writing down notes. You can sit peacefully and understand the whole concept, and you can keep those notebook content in front of you of that particular video, and there if you want to just add or minus some point, you can do that. Otherwise, the notebook creation effort also I have done for you. Students, I will show you the index of that particular book also, the 2 volumes. Students, this is the index. Can you see this? Strategic Financial Management Index, Explanations and Solutions, Volume 1. Okay, so Explanations and Solutions, students, can you see in Volume 1 I have taken first 6 chapters, and students, in Volume 2 I have taken from 7 to 13, 14 to 18 theory chapters. The theory is already there in the question bank. You need not take a separate notebook for it. So as far as the practical chapters are concerned, I have given it to you the notebook also. So you need not worry about taking a monumental effort in writing down the notebook. Everybody following? Yes, as far as practice is concerned, I'll come to that point in some time. Right now, I'm just telling you that I'm announcing a gift for you all, this Explanation and Solution book. And just as I demonstrated that question bank for you, I will demonstrate the Explanation and Solution book also. Same chapter will take Forex. Okay, so I will now take Forex. Can you see this? Foreign exchange exposure and risk management. Children, trust me, the Explanation and Solution book is such that, see what is the heading I gave? Explanations and Solutions, which means whatever I'll be explaining in the videos, whatever necessary part is there out of that you should write in your notebook, I have written and incorporated everything that is required from your studies point of view. Everybody following? So just to show you, now children, can you see this foreign exchange exposure and risk management? Yes, so this is your question bank, students. In this question bank, let us go to any question. Let us take question number, let's say 5. Okay, question number 5. Now question 5, children, of your question bank, the video of course will be there. Now as far as the videos are concerned, which video number question 5 pertains to, that of course you know in the module and video details given at the start of this textbook, everything is mentioned, video number, module name, module number, everything is there. Now as far as the notebook is concerned, I will take you to the notebook now. So I go to the notebook here. This is your notebook, children. In that, children, let us go to question number 5. Okay, so this is question 2, then question 3, then question 4, and then question 5. Can you see this? Video 10, question 5. This is the solution also given to you. Everybody following? Everything is there embedded here. You need not write anything as of now. Everybody following? So students, I am very sure you're feeling excited. And now if you see here, students, I will go back to the textbook here. This question 5, okay, this question 5, if you see, was belonging to, of course, video 10, question 5, this concept of bid, ask and spread. Children, bid, ask and spread, can I say video number 8 involved the theory explanation of bid, ask and spread, right? So children, I will show you how the theory is also given in the explanation book. Yes, video number 8, I will show it to you here. This is video 10, video 9, and can you see this? Video 8, bid, ask and spread. Whatever is the relevant theory that you're supposed to write in your notebooks, that I have given to you in this Explanation and Solution book. Everybody following? Of course, there is a disclaimer I want to give, that just by reading the Explanation and Solution book, you will not be able to understand. You have to compulsorily go through the videos first, understand them. Only then when you come here, you will be able to very easily get a grip on what is written in this particular book. Everybody following? So students, this was as far as the Explanations and Solution book is concerned. So before I go to the next point, children, I will just remove the markings. Okay, and now I go to my last point in this video, after which you can start your first chapter, that is foreign exchange exposure and risk management. Children, the last point now. The last point is that because I am giving you this Explanation and Solution book, as a responsible teacher, I thought that the students should practice a lot, okay, because I am very sure many of you, oh, notebook is there, no need to write. Students, trust me, you will only pass SFM only if you own the subject, and you will not be able to own the subject unless you write and practice, okay. So for that, students, I have come out with something which I am sharing with you all throughout this entire course, okay, throughout this entire course. Within these chapters, I have embedded a lot of test questions. I'll again repeat, within each of these practical chapters, I have embedded a lot of test questions. Now these test questions are given to you only after the relevant concept is taught and also a sum is done. Everybody following? A concept is taught and the sum is done, and a similar sum, if it is there, that I have given to you as a test. And also let me tell you that there are few places here and there where I got a bit ambitious and a bit adventurous, and I decided to give you some difficult sums also as a test where no previous precedent of a similar sum was there. Such sums also very few I have given to you as a test, just to test the waters. Now children, you might ask, sir, very nice, we would like to solve them. Students, do solve them, but I am very sure after solving you might ask, sir, how do I know whether those solutions that we have done are right or not? How do I know it? Students, for that I have given you three options. Please pay attention sequentially. Option number one, to understand whether your solution is right or not, I have given to you the explanation and solution book, right? In that book, all those solutions are also there, okay. I'll again repeat, your option one, to tally your answers with the answer that I want to provide to you, there is this explanation and solution book which I am providing, in which all the solutions of the test questions with those question numbers are already there. You need not worry, okay. So you can tally your answers there. Second, the second option is that if you feel, sir, the answer is there, the solution is there, but still we are not able to get grip on this sum, then don't worry. At the end of every chapter, I have inserted one additional module. I'll again repeat, at the end of every chapter, I have inserted one additional module, which of course I have not kept in the textbook module list. In the module list which is there at the start of every textbook or every chapter, this particular module and video details, you will not find that module here because it is not a separate concept as such. So what I have done is that module is nothing but solutions to test questions, okay. You can see here this particular chapter here ends with 24th module, additional and recent questions from ICAI, but there is one 25th also which I am not showing here. That 25th module involves or includes only those videos which I have shot extra explaining to you the solutions to the test questions, which means the questions which I gave it to you as test, I have solved them also, but my purpose is that you should not see those videos at the start. You should take up the challenge, do the questions, solve them, check with the explanation and solution book, and after that if you are feeling some difficulty, then you may come and view those additional videos. Everybody following? So can I say that first point, the test questions are given to you just so that you get chance to practice. That is my only intention, that you should get chance to practice, you should get a chance to test the waters, and therefore I've given to you few test questions here and there. Children, for understanding whether your answers are right or not, of course after you have solved them, I have given to you the solutions. Option number one is check the solution in the explanation and solution book. Option number two is kindly go to the end of the video list of that particular chapter. One extra module will be there. That module's name will be solutions for test questions, okay. Solutions for test questions will be there. In that, all the test question videos I have shot and given to you, and after that I'm very sure there will be no doubt and you will get complete grip on where you have gone wrong, in case you have gone wrong. Everybody following? Or you might get a lot of confidence that wow, we were able to solve such and such test question. Now children, you might feel, sir, you said three options, right? Yes. The third option is that even after watching the video you still have some doubt. then children, JKSC is offering you a portal for doubt solving on this website itself. Okay, JKSC is offering you a portal for doubt solving on this same website itself, where you can just go and post your doubt. It will directly reach me and none of my subordinates, none of the academic team, nobody. It will straight away come to me and I will personally be solving that doubt within 48 hours. Everybody following? I'll personally solve that doubt within 48 hours and you will be very clear. And this doubt solving portal, children, let me tell you, is not restricted to test questions only. It is available for the entire course that you enroll for. Everybody following? Whatever you're enrolling for that you have doubt in any video, any concept, any module, any chapter, please do ask a doubt. Feel free to ask a doubt. Be shameless in asking a doubt. No problem. We will solve it within 48 hours. We, as in I, personally will be solving your doubt within 48 hours. Everybody following? Okay, students. So these were few points as far as this course is concerned. They were very important for me to share it to you all and you to listen to all this before you start the course. Okay, so students, from my side, I wish you all a very, very, very happy and informative learning process as we go through this beautiful subject of strategic financial management. I will be holding your hands and teaching you everything in detail so that you score minimum 80 marks in this paper of SFM. Yes, that is my goal. My goal, I'll tell you very clearly, my goal is that after this particular course is done by you, when you sit for the examination, there should be no question that comes in the exam which you feel I have not seen. Okay, which you feel I have not seen. You should at that time feel, oh, such and such sum we have done, or a similar sum we have done. So now very simple, let's quickly knock this off. This confidence I want in all of you all, and with that goal in my mind, I created this course, and I'm very sure both of us will be successful in realizing this dream. Yes, the dream that any sum that comes in the exam, you should feel this is something that we have done, we have grip on it, we will be able to very easily knock it off. Yes, so thank you very much, students, for sitting through patiently these introduction videos, which are very important for me to share to you all. And now I welcome you to chapter number 1, that is foreign exchange exposure and risk management. Kindly go through the sequence that I have set. Don't jump around chapters. Okay, it will be difficult then for you to understand, because I am very sure you also understand I have followed a sequence and I want you to follow that sequence. The chapter will be in complete control once you do that. Okay, we will now be looking at question number 1. This question, students, is from where? Yes, it is from the old syllabus of study material, this very chapter Forex. So let's start. Question number 1 from the old study material. Students, I would request you all to pause the video here and read the question very silently, clearly, slowly. Please start. Okay, so students, I hope you read the question. Let us read it together and we will quickly solve it. Okay, let's start. The following spot rates are observed in the foreign currency markets. So currency they have given, and foreign currency per US dollar they have given, which means, students, can I say they are talking from an American's point of view, that per dollar, what is the foreign currency? Per dollar means for every $1, how much is the foreign currency relationship with that dollar. So different spot rates are given to us. Can you see they are also mentioning it here, spot rates given to us in the question. So let me explain to you what is the meaning of British pound 0.62 per dollar. What is the meaning of that? The meaning is very simple, students. It means $1 is equal to 0.62 British pound. Yes, you all are right. $1 is equal to 0.62 British pound. Let's talk of Netherlands guilders. It is also called as Dutch guilders. Can I say Dutch guilders? 1.90 per US dollar. What is the meaning of this? It means $1 is equal to 1.90 Netherlands guilders. Next is Swedish kroner, 6.40 per dollar. What is the meaning of it? It means $1 is equal to 6.4 Swedish kroner. Next they are saying Swiss francs. Swiss francs, students, 1.5 per US dollar. What does it mean? It means $1 is equal to 1.5 Swiss francs. Italian lira, 1300 per US dollar. What is the meaning of it? It means $1 is equal to 1300 Italian lira. And then Japanese yen, 140 per US dollar. What does this mean? It means $1 is equal to 140 Japanese yen. Okay, so on the basis of this information, compute to the nearest second decimal the number of, and then they have asked you 6 different currencies that you have to convert into the other currencies using these very spot rates. So students, without first of all going through these 6 questions that are asked, I would first of all like to take out some time and let us better present these quotes in the way we know it, that $1 is equal to 0.62 British pound and so on. Once we have the quotes in our user friendly form, then we can start attacking each of these 6 points and quickly complete the question. Okay, so let's start, students. This is the question patch I'm putting in front of your screens here, and now let's start the solution. Now students, as we discussed in the previous slide, can I say $1 is equal to 0.62 British pound and so on. Okay, next is $1 is equal to 1.9 Netherlands guilders, $1 is equal to 6.4 Swedish kroners, $1 is equal to 1.5 Swiss francs, $1 is equal to Italian lira 1300, and students, $1 is equal to yen, Japanese yen, 140. Yes, so now that we have the quotes in our user friendly form, the way we like it, now we can start attacking each of those 6 questions one by one. So let's pick up the first one. Let's see what they are asking. They are asking how many British pounds can be acquired for $100. They are asking how many British pounds can be acquired for $100. Can I say you will now need the relationship between pounds and dollars, the spot rate between pounds and dollars in the question. How many British pounds can be acquired for $100? Okay, can I say $1 is equal to British pound 0.62, then for $100 how many British pounds can we acquire? So the answer is very simple. Can I say, I will write here, with $100 we can acquire, can I say we can acquire 100 into 0.62, which is equal to 62 British pounds. Because students, can I say $1 is equal to 0.62 British pounds, so therefore $100 will obviously be 100 into 0.62, that is 62 British pounds. So I hope you understood this point number 1 of question number 1. Kindly pause the video and copy this solution in your notebooks. Okay students, let's now go to the second point. Students, in the second point they are asking dollars that 50 Dutch guilders. Students, Dutch guilders means Netherlands guilders. Okay, a European monetary union legacy currency. This line is of no use to us. Let's read ahead. Will buy. So dollars that 50 Netherlands guilders, Dutch guilders will buy. Students, can I say I will now need the spot rate between Netherlands guilders and dollars, and that spot rate, students, given to us, or we also wrote it in our user friendly form as $1 is equal to NG 1.90. Okay, how many dollars can 50 Dutch guilders buy? So for NG or Dutch guilders 50, how many dollars can we buy? So the answer is very simple. With NG 50, which means with 50 Netherlands guilders, with 50 Dutch guilders, we can buy, it is 50 divided by 1.90, correct? 50 divided by 1.90, because $1 is equal to 1.90 NG. So 50 NG, if you cross multiply, basically it is 50 divided by 1.90, that is nothing but, let's take the calci, 50 divided by 1.9, we will be able to buy $26.32, $26.32. Yes students, so this is the answer to your point number 2. Please copy this solution, pause the video and copy this solution in your notebooks. Okay students, now that you have copied point number 2, let's go to point number 3. So point number 3, now they are asking Swedish krona that can be acquired for $40. The spot rate that we have found out is $1 is equal to Swedish krona 6.40. So therefore for $40, how many Swedish krona can be acquired is the question, correct? It's a very simple calculation. With $40, we can acquire, with $40 we can acquire 40 into 6.40, which is equal to, I'll do on the calci, 40 into 6.4 will give me 256 Swedish kroners. 256 Swedish kroners, yes? So students, I would like you all to pause the video here and copy the solution to point number 3. Okay students, so I hope you have copied point number 3 solution. Let's go to point number 4. Students, in point number 4 they are saying dollars that 200 Swiss francs can buy. Dollars that 200 Swiss francs can buy. I will need the spot rate between dollar and Swiss francs, that is $1 is equal to 1.50 Swiss francs. So if $1 is equal to 1.50 Swiss francs, 200 Swiss francs will get me how many dollars? How many dollars can be bought using 200 Swiss francs? So let's do the solution. Very simple. Can I say with Swiss francs 200 we can buy? Can I say we can buy 200 into 1.5 or 200 divided by 1.5? Obviously we can buy 200 divided by 1.5, and if you do the calculation, 200 divided by 1.5 will give me $133.33. $133.33. Students, in this question we are rounding off to 2 decimals only, because the question itself told us at the start nearest 2 decimal, correct? So please now pause the video here and copy this solution to point number 4. Okay students, so I hope now that you have copied the solution to point number 4, we can safely go to point number 5. Italian lira that can be acquired for $10. That an EMU legacy currency you kindly ignore here. It is of no use for us in this question, so let's read ahead. Italian lira that can be acquired for $10. Students, can I say we will need the spot rate between dollar and lira. The spot rate is $1 is equal to 1300 lira. They are asking how many Italian lira can be acquired for $10. So if $1 is equal to 1300 lira, $10 will be equal to how many lira is the question. With $10 or $10 we can acquire. Students, very simple. If $1 is equal to 1300 lira, $10 can I say will be equal to 10 into 1300, which is equal to Italian lira 13,000. Italian lira 13,000. Very simple question. Kindly pause the video and copy this solution to point number 5. Okay students, so I hope you have completed point number 5. Next, let's go to point number 6, the last point of this question. Dollars that 1000 Japanese yen will buy. We will, can I say, need the quote between dollars and Japanese yen, that is $1 is equal to 140 Japanese yen. We have how many Japanese yen in the question given to us? Can I say 1000 Japanese yen will buy how many dollars? 1000 Japanese yen will buy how many dollars? Very simple. With Japanese yen 1000 we can buy 1000 divided by 140. If you do 1000 divided by 140, you will get $7.14. $7.14. So $7.14 you can buy using 1000 Japanese yen. So students, I hope you understood this point number 6 also. Kindly pause the video and copy this solution. Okay students, so now we have completed the entire question. All 6 points are done. I hope you understood this very simple question from old study material of Forex chapter itself. Now students, currency risk. I had told you in the introduction to strategic financial management subject, that first initial modules of introduction, that the whole subject is broadly divided into 2 parts. Which 2 parts? Can I say valuations and second was risk management. Yes, and now looking at the name of this chapter, students, what is the name of this chapter? Forex is shortcut, but the full name was what? Foreign exchange exposure and risk management. Yes, so therefore this particular chapter belongs to which stream of SFM? It is the risk management stream of SFM. Now therefore students, in this chapter there must be some risk. Yes, there must be some risk which we would be wanting to manage, Students, risk. Come on, I had told you, what does risk refer to in this subject SFM? Come on, risk refers to what? Tell me. Yes, risk refers to the uncertainty caused by future. Yes, can I say, if I am a person who undergoes stress today because of an uncertain future, this stress that I go through today was referred to as risk by me in the introduction to SFM module. Do you remember that? That means in this chapter also there must be some uncertain future that must be causing stress to me today, and that risk is what we will be looking for in this entire chapter. In the introduction to SFM, I had also told you all that risk management means what? Can I say managing risk means, can I say managing uncertainty, and can I say managing uncertainty means creating certainty? Yes, you remember. So creating certainty means what, students? Creating certainty means making us aware today only what will happen in future. There is no uncertainty. This process is called as creating certainty, managing risk, and I had told you that this refers to a very famous term throughout our subject called as hedging. So therefore risk hedging means what, students? Risk hedging means creating certainty. Yes, all this we had discussed in the introduction module to SFM. So now students, in this particular video of the introduction to Forex, I want to explain to you that students, yes, in this chapter also, since it is a risk management chapter, there is some risk that we are going to hedge, and therefore we need to very clearly understand, before we understand the hedging, we have to first understand the risk. What is the risk that is going to be hedged in this particular chapter? Okay, students, now understand the risk. You know, in the previous videos, I was again and again stressing on a word called today. Today. You remember that word today? Why I was stressing on this word today? Because, students, if you go to the bank today to convert any currency into the other, the spot rate which was quoted today is relevant, correct? At the spot rate, your conversion will happen. But students, if you are going to go to the bank to convert one currency into another, not today, but in future. Not today, but in future. Can I say the spot rates which are being quoted today become irrelevant for you? Now students, this spot rate that is irrelevant today makes sense. So sir, then which rate will be applicable and relevant to us? Obviously students, the spot rate which will be quoted by the bank on the date you approach the bank to convert the currency, that rate will be applicable and relevant to you. Na? Today's rate, how it will be applicable to you? Because today you are not going to the bank to convert the currency into another. You are saying that you will go to the bank to convert the currency not today but sometime in future. So okay, when you go in future, at that time whatever is the spot rate quoted by the bank then means the date when you go to the bank to convert your currency, can I say that date spot rate will be relevant to you. Today's spot rate, can I say, is irrelevant, correct? So students, understand the risk here. Can I say, if you are a person who knows today, okay, you are a person who knows today that you will be going to the bank in future to convert a foreign currency to home currency. Listen to me carefully. You are a person who knows today that you will be going to the bank in future to convert a foreign currency to home currency. Can I say straight away, you are under risk. Why you are under risk? Because today you don't know what you don't know. Can I say today you don't know what the relationship will be between the foreign currency and home currency. Today you don't know what will be the spot rate then when you go to the bank to convert the foreign currency to home currency. Today you don't know how much home currency you will be converting the foreign currency to when you go to the bank to convert the foreign currency to home currency. And this today I don't know situation is risk. Yes, that situation is risk. You will be under stress because you don't know what is going to happen to you in future. And this risk, student, is what we will be referring to as currency risk. Now this currency risk I will explain to you with the help of a small example. Please pay attention on your screens. So now there is this example. Read it carefully. Come on. On 1st of January, okay, on 1st of January, an Indian exporter, okay, now 1st January, Indian exporter. Who is an Indian exporter, students? Can I say exporter is a person who, being an Indian exporter, means he is an Indian and he is selling goods to foreign. Importer means what? Obviously importer means a person who is buying goods from foreign. Okay, so now let's take an example of an exporter. Students, I am very sure you are understanding here why I am taking exporter importer examples. Why not domestic examples? Because students, if I take domestic examples, can I say the bill amount will be in rupees only. Forex chapter will become void ab initio for everybody. This chapter will be of no use. This chapter will only be of use for those people who are dealing in foreign currencies. And can I say exporter importers are the best examples I can give you who are in India but dealing in foreign currencies. And therefore for these people, all these foreign currencies and their relationships with the home currency will be relevant. So let's continue the example. On 1/1, an Indian exporter sells goods to a USA customer worth $1 lakh when the spot rate is $1 equal to rupees 100. What is the story? On 1st of January, there is an Indian exporter. He sells goods. He sells goods to whom? To a USA customer. He sells goods to a USA customer worth how much, students? He sells goods to a USA customer worth $1 lakh. And $1 lakh is what he will now receive from the USA customer. And today when he approaches the bank to ask for the relationship between dollar and rupee, let's say the bank says that today the quote is $1 is equal to rupees 100. Students, what is this rate called as? Yes, you all know it is nothing but the spot rate. Have you received the dollars yet? No. You have only sold. You have only sold goods. You have not yet received dollars, and now there is a twist in the tale. The twist is that the money is receivable not today. Yes, the money is receivable not today. It is receivable in 3 months' time. It is receivable in 3 months' time. So students, tell me, tell me, is this $1 equal to rupees 100 spot rate of any relevance to you? Is it of any relevance to you? Absolutely no. Why no? I will tell it to you why no. Students, this is your bill amount, correct? Your bill is of $1 lakh. Yes, your bill is of $1 lakh. But students, you will be receiving those $1 lakh not on 1st of January when you sold the goods, but on 1st of April when you will receive the money, because the payment period is a 3 months period. Correct? So students, tell me, is the spot rate of any use to you? Absolutely no. I am just scrapping this. This is of no use to us. Therefore, tell me, which spot rate will be of use to us? Yes, you are all right. The spot rate which will be quoted on 1/4, the spot rate which will be quoted on 1/4 by the bank will be relevant to us. And students, tell me, do you know that spot rate on 1/1? No. And since you don't know that spot rate on 1/1, since you don't know that spot rate on the day you sold goods to the American customer, can I say you are under risk? You are facing an uncertain future. Please know that the uncertainty is not in the receipt of $1 lakh. No, you will get $1 lakh. The uncertainty isn't in the receipt of dollar. The uncertainty is in the receipt of home currency, that is rupees. Yes, you will be getting some rupees. If you get the dollars, you will convert it to rupees. You will definitely get some rupees. Yes, but how much rupees you will get is a question of uncertainty. You don't know. You don't know today. Why you don't know today? Because the spot rate today is irrelevant. The spot rate on 1/4, can I say, will be relevant, and that rate, students, you don't know today. Straight away you are under stress. You are under risk. You don't know. You know you're going to get $1 lakh, but you don't know that when these $1 lakh you will be converting to rupees. When you take these $1 lakh and sell it to the bank to get rupees, how much rupees you will get is what you don't know, because you don't know the spot rate on 1/4. Students, this exactly is called as currency risk. This is exactly what is called as currency risk. And let's see how many of you are smart. Can I say currency risk will not touch a person? Currency risk will not touch a person if they are doing cash transactions in foreign. What is the meaning of cash transactions? Cash transactions means if the money was receivable today itself, if the money was receivable today itself, can I say then the $1 equal to rupees 100 quote would have been applicable to you, because you would have got dollars today only. You would have gone to the bank and you would have sold these dollars. $1 lakh you would have sold at the rate rupees 100 per dollar. Can I say you would have got rupees 1 crore, correct? You would have got rupees 1 crore, but now, can I say this today transaction is not happening, na? Cash transaction is not happening, na? What is happening is a credit transaction, and because it is a credit transaction, can I say for you, foreign currency is not happening today. For you, foreign currency is happening after 3 months. What is the meaning of happening? In this example, foreign currency is not received by you today. Foreign currency is received by you after 3 months. Therefore, on today's time scale, can I say foreign currency is receivable, and the moment foreign currency is receivable, today's spot rate becomes irrelevant and you fall into this pit called currency risk. And it is not only for receivable, students, it is also, can I say, for payables, correct? If there is a person who knows today that he has to pay foreign currency in future, who must such a person be? Let's say he is an Indian importer. He has purchased goods from a US supplier and he has to pay $1 lakh in 3 months time. Can I say he again falls into a currency risk situation, because he knows that after 3 months he will have to go to the bank to convert rupees to dollars, because he will be now selling rupees and buying dollars, because that dollars, can I say, he will use to pay his US supplier. So basically, whether you are an Indian importer or an exporter, whether foreign currency is receivable or payable, students, the receipt or payment is not relevant. The fact that it is not happening today is relevant. It is receivable or payable. This causes stress to you, because you know today that something in foreign currency is happening to you in future, correct? And therefore, you fall into this whole zone of currency risk. of uncertainty. Let's say in this example, you are an exporter, correct? Today, $1 is equal to rupees 100. Yes, this is the today's rate. On 1/4, that is after 3 months, what are you fearing? You are fearing what if $1 becomes rupees 90, correct? This is what you are fearing. Yes, $1 equal to 90 if it happens. Say when you get your $1 lakh and you go to the bank to convert these dollars into rupees, can I say you will end up getting rupees 90 lakh only? Correct? You will end up getting rupees 90 lakh only, because at that time the spot rate was $1 equal to rupees 90. So students, this is a fear, right? What is the fear? Because when you sold the goods, in your mind, can I say you had 1 crore rupees considering the spot rate today. But since the spot rate today is not going to be applicable, the spot rate which will be applicable is after 3 months, can I say you are fearing. You are fearing, what if dollar drops? What if dollar weakens? What if dollar depreciates? Yes, students, this rupees 100 has become rupee 90. Don't think rupee has fallen up, please. This 100 has gone to 90 means, can I say dollar has fallen? $1 was rupees 100. Now $1 is only rupees 90, which means who has fallen? Dollar has fallen. Dollar has depreciated. This depreciation is what this exporter is fearing, and that is what is causing him stress. But students, this dollar could have also gone to rupees 110, correct? Dollar from 100 could have gone to 110. Therefore, dollar could have also appreciated. It could have strengthened, correct? And that would have given the exporter rupees 1 crore 10 lakhs. The point is, it is not about how much rupees he will get. The point is, he doesn't know today how much rupees he will get, and that is called as uncertainty, that is called as currency risk. And such a currency risk, students, is applicable only to such people who know today that they are going to either receive foreign currency or pay foreign currency in future. So students, here I am writing the definition of currency risk here. Currency risk refers to uncertainty caused by exchange rate fluctuations to a person to whom foreign currency is either receivable or payable. Receivable or payable. And students, in this chapter, we also refer to currency risk as transaction risk. We refer to currency risk as transaction risk. Okay. So students, can pause the video here and copy these notes only. What is there on your screens here, please copy. Pause the video and copy this. Okay students, so therefore I hope you understood what is transaction risk, what is currency risk. Then now that you have understood the risk, we have to now understand how to manage this risk, how to hedge this risk. I will show you 1 minute only something now in this particular video. Students, in this particular chapter now, we have got certain risk hedging tools that we will be studying. Okay, these are the various tools that you will be studying. Now students, in this I want you all to focus on these 4 which I have put on the left side. Forward cover, money market hedging, leading and netting. Students, these 4 we will be studying in this chapter. What are these 4? These are risk hedging tools. Don't forget, risk hedging tools means what? They will be hedging our which risk? Currency risk. Students, what is the meaning of hedging currency risk? Means, can I say they will help us create certainty today only. What is the meaning of helping us create certainty today only? It will help that exporter know today only how much rupees he will get after 3 months. These tools will help the importer know today only how much rupees they have to pay after 3 months, which means creating certainty means helping them sleep peacefully. Basically, this subject is all about helping a person sleep peacefully. How peacefully? By helping them know today only what will happen to them in future, thereby removing all uncertainty. So these are the 4 tools that will help that exporter sleep peacefully, create certainty, know today only what will happen in home currency. Exporter may it be or importer, yes. And what about these 3? Yes students, these 3 we will be dealing in further chapters. There is a chapter called as derivatives which we will be starting. The whole chapter, students, is based on this concept of futures and options, which obviously in this chapter we will be studying on the share market. And once I teach you the futures and options on the share market, then to understand futures and options in the currency market, in the foreign exchange, it is very simple. And then swaps, there is another chapter called as interest rate derivatives. Okay, interest rate derivatives I'll write here. Students, once this chapter is done, in that chapter only I will teach you currency swaps also. It's a very simple concept. So there are 3 risk hedging tools, currency risk hedging tools, which I will not be taking in this particular chapter, but these 4, forward cover, money market, leading and netting, I will be teaching to you in this very chapter itself. Students, any quote, okay, any quote you take in this world, okay, not necessarily foreign exchange quote, any quote you take has 2 components, a product and a price. I'll give you a simple example. Let's say 1 pen equal to rupees 20. Okay, 1 pen equal to rupees 20. Students, can I say this is also a quote? Now look at the quote and tell me, in this quote, which part is the product and which part is the price? Yes, you have just did right. Can I say the pen is the product and price is rupees 20? So students, this quote is there in front of your screen. So 1 pen equal to rupees 20, and as I said that in this quote the product element is the pen and the price element is rupees 20, which means any quote you take from now on will have 2 components. Which 2 components? Product and price, correct? And now I will tell you one very important sentence. Please pay attention. A quote is always of the product. The quote is never of the price. The quote is always of the product. Students, tell me, this quote is of the pen or is it of rupees 20? Think hard. Is this quote of rupees 20 or is this quote of 1 pen? Obviously, this quote is of 1 pen, correct? This means that if I go to buy 1 pen, I have to pay rupees 20. If I go to sell 1 pen, I will get rupees 20. This is a quote obviously of what? It is a quote obviously of the pen. You don't say that if I sell rupees 20, I will get 1 pen, correct? Or you don't say to buy rupees 20, I have to pay 1 pen. No, it sounds obnoxious, correct? This quote is not of rupees 20. This quote is of 1 pen. Therefore, what I'm trying to explain to you is very important for this chapter. Always remember, a quote is not of the price. A quote is always of the product. Therefore, I write this line here. This quote is of the pen in terms of rupees. Rupees is the price in terms of price, correct? So this quote is a quote of pen in terms of rupees, correct? Now students, you have understood product and price in a quote. Let us take a foreign exchange quote and let's try understanding what is the product and price in that particular quote. So next example I put in front of your screens is $1 equal to rupees 100. $1 equal to rupees 100. I am very sure all of you have understood. Tell me, in this quote, what is the product? Obviously the product is $1 and the price, students, is rupees 100. Therefore, yes, you are right. In a foreign exchange quote, okay, listen carefully. In a foreign exchange quote, that currency whose unit is 1, okay, that currency whose unit is 1 is the product and the other currency is the price. That currency whose unit is 1 is the product and the other currency is the price. Now students, tell me, this quote, $1 equal to rupees 100. Come on, tell me students, this quote is a quote of, yes, you are right, it is a quote of dollars in terms of rupees. It is a quote of dollars. A quote is always of the product, right? And here the product is dollars. Hence, this is a quote of dollar. It's not a quote of 100 rupees. It is a quote of dollar expressed in terms of rupees. I'll give another example to you. Come on. 1 pound equal to yen 500. Tell me, 1 pound equal to yen 500. Come on students, tell me who is the product here. Yes, you are right. The product here is of course 1 pound and it is expressed in terms of price yen 500. And this quote, students, is a quote of, yes, it is a quote of pound expressed in terms of yen. It is a quote of pounds expressed in terms of yen. So students, I am very sure you have understood product and price and how a quote is always of the product expressed in terms of price. And in a foreign exchange quote, how do you identify the product? Yes, just look at that currency whose unit is 1. That particular currency will be taken as the product and the other currency will be taken as the price. There is one exception. Sometimes students, the question might give you rupees 100 is equal to 345 yen. A quote like this if it comes, then what is the product, you might ask. No problem. In such a particular quote, please take that currency whose units are 100 as the product and the other currency is the price. So basically 99% of the times you will have quotes where the unit is 1. One of the currencies unit has to be 1 and the other currency will have a number, another number other than 1 obviously. Or exceptional case might come where rupees 100 is equal to 345 yen type questions might come. Then please take that currency whose units are 100 as the product and the other currency therefore becomes the price. Now students, I would want you all to write something, okay? I'll give you an example which I took in the previous slide. Just copy that example and I'll give you something to write here, okay? Students, do you remember this example? Now what you should do is just copy this example as it is from your slide. Pause the video and copy this. Okay students, I hope you have copied this and below this you can write one more thing here. The currency whose unit is either 1 or 100 is the product and the other currency is the price, okay? So kindly pause the video and write this note also below this particular example. Okay students, so I hope you have copied this. So now at the end of this video, I will give you one more example. Try it and tell me which is the product and which is the price, okay? Students, last example in this video. Come on, 1 Singapore dollar is equal to 12 Australian dollars. 1 Singapore dollar equal to 12 Australian dollars. Very simple students. Can I say the product here is Singapore dollar and the price here is Australian dollar 12. Tell me, this is a quote of? Yes, this is a quote of Singapore dollar expressed in terms of Australian dollars. So students, I hope you understood this particular video where we studied the difference between product and price in a foreign exchange quote. As a conclusion, I will tell, in a foreign exchange quote, in a spot rate, that currency whose unit is 1 most of the times or 100 sometimes is the product and the other currency will be the price. So now that you have understood product and price in a foreign exchange quote, let us now understand direct and indirect quotes in this particular video. So therefore this becomes the theory video of this particular module. Let's start, okay? Students, I'll put a quote in front of your screens. $1 equal to rupees 100, okay? $1 equal to rupees 100. Listen carefully, don't panic, don't jump, why, what, how, just peacefully listen. $1 equal to rupees 100, students, is called as a direct quote, okay? I'll explain, don't worry. It is called as what? It is called as a direct quote for which country? For India. It is called as a direct quote for India. How do I identify what is a direct quote? Very simple. Please understand that if the product in a quote, what is the product in this quote, students? Can I say the product here is dollar if the product is foreign currency and if the price is expressed in home currency, okay, can I say for you, home currency here is, can I say rupee, you are an Indian, so I'll again repeat, if the product is foreign currency and the price is home currency, such a quote becomes a direct quote for home. Such a quote becomes direct quote for home. So students, direct quote's definition is what? Direct quote refers to that quote where the product is a foreign currency expressed in terms of home currency price. Such a quote becomes a direct quote for home. Students, here the price was rupees and therefore rupees is the home currency for which country? India. Therefore this particular quote becomes a direct quote for India. Students, it's very simple to understand. Let's say I am an Indian. I want to know $1 is equal to how much my currency, correct? My currency, how much I have to pay to get a foreign currency becomes a direct quote for me, correct? Therefore, a direct quote is that quote in which there is a foreign currency expressed in terms of our home currency, correct? Students, it is very simple to understand. I'll give you a shortcut. Please listen to this carefully, okay? I'm removing everything here. Just pay attention. If this quote is given to you in the question and they ask you, it is a direct quote of which country? Okay, they ask you it's a direct quote of which country? Forget product and price combined. Just focus on price. Simply focus on price. Check the price is in which currency. Can I say the price here is in rupees? So we say price is in rupees. Rupees is the home currency of which country? It is the home currency of India. Game over. This is a direct quote for India. So simple. Just check the price. Simply check the price. That price, if it is expressed in a currency, just check that currency is the home currency of which country. Then that quote is a direct quote for that particular country. Okay. So to shorten things, what I will say is, I will remove all these markings here. Okay. And I will rewrite here. Product is one unit of foreign currency. Price, can I say, is expressed in home currency. Then such a quote is a direct quote for home. Such a quote is direct quote for home. So I will just write one line here. To identify, okay, to identify whether a quote is a DQ or not. To identify whether a quote is a DQ or not, just check the price, okay? Just check the price. The quote is a direct quote for the country whose currency is in price. Whose currency is in price. So therefore students, can I say if $1 is equal to rupees 100, this is a direct quote for which country? Simple, just check the price. Okay, this quote will become direct quote for that country whose currency is there in price. Here the currencies, can I say rupee? Rupee is the currency of which country? India. Hence it is a direct quote for India. Students, so kindly pause the video here and copy these notes in your notebook. Okay, so now that you have understood how to identify a direct quote just by looking at the price, I will give you few examples. Get me the answer, come on. So the next quote I'm putting in front of your screens is 1 pound equal to yen 500. Okay, 1 pound equal to yen 500. Tell me, this is a direct quote for which country? Come on, come on, look at only what? Look at only the price. Price is expressed in yen. Yen is the currency of which country? Japan. You are right. This quote is a direct quote for Japan. You are all right. I'll give you one more example. Last example. Come on. 1 Singapore dollar is equal to 12 Australian dollars. 1 Singapore dollar equal to 12 Australian dollars. Come on, tell me, this is a direct quote for which country? Just look at the price. Can I say price is 12 Australian dollars? This Australian dollars belongs to which country? It's a currency of which country? Obviously Australia. So students, this is a direct quote for Australia. It is a direct quote for Australia. You're all perfectly correct. Now students, I will come back to the original quote. $1 is equal to rupees 100. Can I say this is a direct quote for India? Students, do you realize that in this quote, dollar is the product and rupees is the price? Can we convert this quote where the rupee becomes the product and dollar becomes the price? Obviously yes, rupee becomes the product means can I say 1 rupee is equal to dollar how much is a quote where the rupee is the product. How to calculate? Simple, just take the reciprocal, correct? So can I say if I take the reciprocal, 1 rupee is equal to dollar 1 by 100. 1 rupee is equal to dollar 1 by 100. Can I say, I can also write it as 1 rupee is equal to dollar 0.01. Students, this quote where rupee is the product and dollar is the price is called as indirect quote for India. It is called as indirect quote for India. Now students, how do I identify an indirect quote? No need to identify. Simply identify direct quote only. Students, if this comes in the exam, come on. If this comes in the exam, 1 rupee is equal to dollar 0.01. If this comes in the exam, tell me, this is a quote where what is the product? Can I say rupee is the product? What is the price here? Dollar is the price. Tell me, this quote is a direct quote for which country? Yes, you are right. It is a direct quote obviously for USA. It is a direct quote for United States of America because the price is expressed in terms of dollar, that is the currency of USA. So no problem. If this quote is a direct quote for USA, it must be an indirect quote for India. It is so simple. Students, please tell me, look at this first quote here, this quote here. This quote is a direct quote for which country? It's a direct quote for India. Therefore, it must be an indirect quote for USA. It must be an indirect quote for USA. Students, can I say, to shorten things, indirect quote is nothing but a reciprocal of direct quote, correct? Indirect quote is a reciprocal of direct quote. So students, I would want you all now to pause the video here and kindly copy what is there in front of your screens now. Please pause the video and copy this. Okay students, so now that you have understood indirect quote also, I will now give you 2 examples more to strengthen your indirect quote understanding. Come on, 1 pound equal to yen 500 was a direct quote for Japan, right? What will be an indirect quote for Japan? Reciprocal. Can I say reciprocal is 1 yen is equal to pound 1 by 500. If you do on calci, 1 by 500 will come to 1 yen is equal to pound 0.002. 1 yen is equal to pound 0.002. Students, this becomes an indirect quote for which country? Yes, it is an indirect quote for Japan only, students, okay? And this is a direct quote, students, for which country? Look at the quote. Can I say the price is expressed in pounds? It is a direct quote for obviously the United Kingdom because the pound, that is the price, is the currency of UK. Last example, students. Now quickly tell me, 1 Singapore dollar is equal to how many Australian dollars? Come on. 1 Singapore dollar is equal to 12 Australian dollars is the direct quote for, can I say, Australia? Yes. Students, what is the indirect quote for Australia? Can I say 1 Australian dollar will be equal to Singapore dollar 1 by 12. If I calculate 1 divided by 12, I will get 1 Australian dollar is equal to SGD 0.0833. 1 Australian dollar is equal to SGD 0.0833. Students, tell me, this is an indirect quote for which country? It is an indirect quote obviously for Australia itself. Okay, it is an indirect quote for Australia. But students, it is a direct quote for, tell me which country? It's a direct quote for Singapore dollar is the price. It's a direct quote for obviously Singapore. Okay, it's a direct quote for Singapore. So students, I hope you all understood how to identify direct quotes and indirect quotes. Therefore students, what is the conclusion now? What did you understand in this particular video? Direct quote and indirect quote. How do I identify direct quote? Just look at the price in the quote, correct? And this quote becomes a direct quote for which country? It becomes a direct quote for that country whose currency is there in the price, and for the other country this same quote becomes an indirect quote. And mathematically speaking, can I say students, indirect quote is nothing but 1 upon direct quote, correct? Indirect quote is nothing but a reciprocal of direct quote. So students, $1 is equal to rupees 100. Come on, this is a direct quote for which country? It's a direct quote for India. At the same time, this is an indirect quote for USA. Yes, you are right, it's an indirect quote for USA. But if I convert this quote, if I take a reciprocal, 1 rupee is equal to $0.01, I will get, this becomes a direct quote for USA, and this is obviously an indirect quote for India. So students, I hope you understood direct and indirect quotes. My simple request to you is, don't worry much about indirect quotes. Only focus on direct quotes. Okay, once you get the direct quotes, indirect quotes is a simple calculation. Take a reciprocal. Okay, so now that you have understood what is a direct quote and an indirect quote, let us now go on to the next question, that is question number 2. So students, in front of your screens I am putting this question. I want you all to pause the video, read the question and try solving on your own. Start. Okay friends, so I hope you have read it and you also tried solving. Let's now do it together. Okay, so I'm reading the question now. Identify whether the following quotes offered by a Kolkata bank. See, Kolkata bank, this is important because they are saying that you are from India, correct? Kolkata is in India. So they are saying identify whether the following quotes offered by a Kolkata bank are in direct or indirect format and provide the corresponding indirect or direct quotes, which means what you have to do, you have to first of all identify whether the quote given to you is a direct quote for a Kolkata bank or an indirect quote for a Kolkata bank, which means for India. And then you have to calculate the reciprocal quote, which means if the quote given is a direct quote, calculate the indirect quote. If the quote given is an indirect quote, calculate the direct quote. So now students, let's start the solution. Okay students, now please focus on this question patch that I have put in front of your screens. Look at the first row. They are saying rupees per ZAR, and ZAR rand is the currency of South Africa and the rate is 5.3400. What is the meaning of students rupees per ZAR? That means it must be 1 ZAR is equal to rupees 5.3400, obviously correct. 1 ZAR is equal to rupees 5.3400. Similarly, this must be 1 rupee is equal to kroner 0.1623. Similarly, 1 pound must be equal to rupees 72.7600 and 1 rupee must be equal to real 0.0737. So these are the quotes given to us students. What we will do is we will first convert in a sense, better present the quotes the way we know it in this format here, that 1 unit of currency is equal to some units of other currency. We will place these quotes in this particular fashion and then try solving the question. Okay, so let's start. Students, please read these quotes carefully. See, rupees per ZAR, can I say 1 ZAR is equal to rupees 5.34. Kroner per rupee means 1 rupee is equal to kroner 0.1623. Rupees per pound means 1 pound is equal to rupees 72.7600. And real per rupee means 1 rupee is equal to real 0.0737. Okay. Now students, these quotes are offered by which bank? They are offered by an Indian bank, that is Kolkata obviously. And therefore we have to check whether these quotes are direct or indirect quotes for India, correct? And to know whether it is a direct or indirect quote for India, what did I tell you in the previous video? Just check the price. Students, being an Indian bank, the price, can I say if the price is in Indian currency, home currency, that is rupees, if the price is in rupees, can I say that quote will be a direct quote for India? And if the price is in foreign currency, product is in rupees, obviously somewhere rupees has to be there, correct? So if the price is not rupees, product is rupees. So the product is rupees, price is not rupees, then it is obviously not a direct quote for India. It will be an indirect quote for India. So let's start solving this question now. Okay, so first quote, 1 ZAR equal to rupees 5.34. Students, tell me in this quote, who is the product? Can I say the product is ZAR? What is the price? Can I say price is expressed in terms of rupees? Since the price is expressed in terms of rupees, can I say the quote status is a direct quote? The quote status is a direct quote. Reciprocal quote I will do at the end. Let's read ahead. 1 rupee is equal to kroner SEK 0.1623. Students, can I say the product here is rupee, the price here is expressed in terms of SEK. Because the price is not in rupees, rupees has gone in product, can I say the quote status for India will be this quote is an indirect quote. Very good. Next, 1 pound is equal to rupees 72.76. Can I say the product is pound, price is expressed in rupees? Because the price is expressed in rupees, Indian home currency, it becomes a direct quote for India. And then 1 rupee is equal to SAR, real 0.0737. Can I say the product is rupees? The price is expressed in foreign currency SAR. I know you all understood. It is obviously an IDQ. And all those of you who have tried this question, I am very sure you got this answer 100%. Yes, now let's do the reciprocal quote. Students, reciprocal quote means what? Can I say if 1 ZAR is equal to rupees 5.34, can I say 1 rupee will be equal to ZAR 1 upon 5.34. So if I take the calci, 1 divided by 5.34, if we do, we get 0.1873, correct? The reciprocal quote. Next, 1 rupee is equal to SEK 0.1623. Can I say the reciprocal quote will be 1 SEK is equal to rupees? Students, 1 SEK will be equal to rupees how much? 1 divided by 0.1623, if I do, I get 6.1614. Yes, 1614. Next, can I say 1 pound is equal to rupees 72.76. 1 pound is equal to rupees 72.76. Can I say the reciprocal quote will be 1 rupee is equal to pound, 1 divided by 72.76. I will get 0.0137. We will take 4 decimals always, yeah, 0.0137 unless otherwise specified in the question. We will take a 4 decimal code, that is 0.0137. And the last one is 1 rupee is equal to SAR 0.0737. So can I say the reciprocal quote will be 1 SAR is equal to rupees. Can I say 1 divided by 0.0737, if we do, we will get 13.5685. 13.5685. Yes, students, so therefore this particular question is over. I hope you understood. It's a very simple question. There was nothing much. We had to just identify the direct quotes or the indirect quotes and calculate the reciprocal. Do you all understand that if this was a direct quote, this is an indirect quote, right? If this was an indirect quote, this becomes a direct quote. This is direct quote, this is an indirect quote. This is indirect quote, this is direct quote, all for India, for Indian Bank, for Kolkata Bank. Okay, students, so therefore we end the solution to question number 2. I would want you all to now silently copy this solution to question number 2 in your notebooks. Kindly pause the video here, copy the solution, and then we'll go ahead. Okay, students, so I hope you have written down the solution to question 2. In the next video, we will be seeing another question on the same concept of direct and indirect quotes, so as to make your basics very strong on DQ and IDQ. See you in the next video. Thank you so much.